Is the stock market a magician's paradise or a ticking time bomb? Stick around to find out why even experts like Michael Burry might not have all the answers. If you're intrigued, hit that like button. You've probably heard the buzz. Michael Burry, the man who foresaw the 2008 housing crisis, has placed a $1.6 billion bet against the stock market. Media outlets are ablaze with headlines, but here's the twist. They've got it wrong. Why? It's all about the 13F filing, a quarterly report card from the SEC. Burry's latest 13F suggests he's betting big against the market, but the media's interpretation is misleading. For the casual investor who doesn't live on financial YouTube channels, this is alarming. The guy who predicted the 2008 meltdown seems to be going all in against the stock market again. Sounds like a recipe for chaos, right? Well, hold on. Today we're diving deep into this high-stakes market bet. Quick disclaimer, I'm not a financial advisor. Your investment choices should align with your unique financial goals and risk tolerance. But let's clear up why a $1.6 billion bet isn't what it seems. Confused? You're not alone. 13F filings require disclosure of stock holdings and options, both calls and puts. Let's simplify this with an analogy. Imagine you and a friend find a rare book priced at $10. You only have $1, but your friend offers to hold the book for a week for that dollar. If the price jumps to $20, you can still buy it for $10, making a profit. If it drops, you lose nothing but the dollar. That's a call option in a nutshell. Now, what about put options, like what Burry did? Suppose you own that rare book and fear its value will drop. Your friend offers to buy it for $10 next week for your last dollar. If the value drops, you profit. If not, you lose the dollar. That's a put option. In the stock world, one contract isn't just one share, it's 100 shares. So you need at least 100 shares to play this game. Now back to Burry. The media misread his 13F, confusing notional value with actual value. Notional is the hypothetical worth of all stocks within those options, while actual is what Burry really paid. So his real bet is likely a fraction of what's reported, perhaps just 1 to 2% of his portfolio as a safety net. Now, let's circle back to Michael Burry's recent bet. The media misinterpreted his 13F filings, which showed two specific put options against SPY and QQQ, ETFs that represent the S&P 500 and the tech sector respectively. On the surface, it looked like he had invested nearly 94% of his entire portfolio against these sectors. But here's where the media tripped up. They confused notional value with actual value. The actual value is what Burry paid for the options, while the notional value is the hypothetical worth of all the stocks within those options. To clarify, let's revisit our bookstore example. If you had an agreement with your friend involving not just one book but 100, the notional value would be $1,000, even though the actual value, the premium you paid, is far less. The bottom line is, Michael Burry's real wager against the market is likely closer to 1 to 2% of his entire portfolio, costing him perhaps a few $1 million as a safeguard, not the $1.6 billion the media suggests. But before we jump on the Burry bandwagon, let's consider his track record. Yes, he nailed the 2008 housing crisis, but he's had his share of misses. For instance, he predicted a market crash in 2015. Instead, it rose by 11%. In 2017, he warned of a global meltdown. The market surged 19%. More recently, in 2023, he advised selling due to recession fears, yet the market climbed 17%. So while Burry's a seasoned player, he's not infallible. The takeaway? Predictions are a dime a dozen. The more you make, the higher the odds some will hit the mark. So when I say the market will rise, what's the time frame? If it's indefinite, all forecasts will eventually come true. Take it all with a grain of salt. No one has a crystal ball. So what's my strategy? I'll continue to dollar cost average into the market. It's a proven method for long-term gains. Your investment journey is uniquely yours, so don't let headlines distract you from your financial goals. Now, about that hook at the beginning, is the stock market a magician's paradise or a ticking time bomb? The answer is, it can be both, depending on your perspective and strategy. But one thing's for sure, it's not as simple as betting for or against it. If you found this video insightful, don't forget to hit that like button and subscribe for more nuanced takes on the market. Thanks for spending your time with me today. Until next time, take care and invest wisely. Goodbye.